What do these power tools, the table that they're sitting on, everything in this space, and even this house have in common? About this truck, this shed, all of them have helped me reduce my federal income tax to zero. Now, I know that sounds impossible, but it's 100% legal and actually encouraged, oddly enough. And if you've seen my video, Borrow Till You Die, today I'm talking about what powers that entire strategy. Don't worry, I'll give you a quick recap of it if you haven't seen that video yet. But before you can borrow your way to lifelong tax freedom, you first need to learn how to erase your income taxes. And today, I'll show you exactly how the wealthy do it step by step using something hidden deep in the tax code under section 168K of the Internal Revenue Code. Now, every week, millions of people work hard, make money, and then they watch half of it vanish. Most people accept that it's just the way it is. But the rich, they play by a different game. Same rules, different game. And it all comes down to a mindset shift. The IRS doesn't punish the rich. It actually incentivizes them. Hear me out. That's because the government, as crazy as it sounds, doesn't want your tax dollars. I know, it sounds even more insane when I actually say it out loud, but really what the government wants you to do is to create jobs, build housing, and really ultimately invest in the economy to grow the GDP. And the IRS will literally reward you for doing that. Let me give you a quick overview of how the Borrow Till You Die tax strategy actually works so you can see how what we're about to talk about today just made it even better. So you work and make money, and then you pay taxes. A lot of taxes for some people. That's the default cycle for most folks. Get taxed to repeat. But the wealthy play a different game. Instead of paying those taxes, they borrow money to buy what I call a 3X asset, an investment that returns roughly 3 times the initial sunk investment cost within 3 years, through a combination of tax savings, cash flow, and equity appreciation. Now, here's the key. You only buy assets that come with asymmetrical tax advantages. In other words, properties that deliver far greater tax savings than anything else of similar value. Think of tools, heavy equipment, vehicles, houses, or sometimes even entire businesses. Now, as you accumulate more of these assets, 2 things happen simultaneously. Your income and net worth goes up, while your taxable income goes down. Now, when interest rates are favorable, you borrow again, sometimes even before the next opportunity exists, so that when the right deal appears, you have cash available and you're ready to make the move. Then you buy another 3X asset and another, and then you repeat this cycle, borrowing, building, and reinvesting until the end of your life. And here's the final twist. When you pass, your portfolio resets in value through what's called a step up in basis, meaning that your heirs that inherit those assets without paying the taxes that you deferred during your lifetime. And that, put simply, is how the wealthy live off of debt, build generational wealth, and legally avoid income taxes for their entire lives. Now, the thing is, you can do the same.
Okay, so most people pay somewhere between 20 to 30% of their income in taxes. And for some, it's even worse. They're giving up like half of what they make. I personally hate it. So on November 26th, this month, my good friend and business partner Rob Solo and I are hosting a free live workshop for our subscribers and followers. We're gonna be breaking down what's really happening in real estate right now and how we're helping hundreds of people wipe out huge portions of their taxes while building cash flowing properties. We're gonna answer your questions live, give away some solid freebies, and even show real examples of projects that have saved us literally millions of dollars in taxes and generated millions of dollars in equity and profits. Registration link is down below. Seats are limited, so make sure you grab your spot before they're gone, and I'll see you on the 26th.
So that last part is what we're really interested in, because when we're wiping out our federal income taxes, we're actually really deferring it. We can only kick the bucket so far down the road, and ideally never having to pay for it alive or in the ground. Let's make this simple. You run a widget factory. You have expenses. You deduct those expenses, pay less in taxes, and the government's happy because you're growing your business and creating jobs. That's how the system's supposed to work. Now, replace the widget factory with a house. When your home operates as a rental, the same rules apply. Except here's where it gets a little bit wild. The tax code allows you to have the base building get depreciated over 27.5 years. Meaning if you bought a home for approximately $350,000, let's say the home is worth $200,000, you can deduct that over 27.5 years, which is approximately $7,000 per year, from your rental income. Good, but not really game changing. However, Congress passed a tax law that changes the entire game for everybody. They brought back what I call a zombie tax law called a bonus depreciation. It's like hitting fast forward on the tax savings. Instead of deducting the cost of your home over 27.5 years or even 39 years in some cases, you can deduct most of it in year 1. You can literally take hundreds of thousands of dollars in deductions the moment your property goes live, or what we call rent-ready status. Okay, but by now, a lot of us have heard that it's called a loophole. Why is that? And that's because usually business expenses can only be deducted from business income. However, there's a way for you to take your rental losses against your ordinary W-2 income. And that's why it's called a loophole. Now, I personally don't really see it as a loophole. I see it as more as an incentive and a reward for doing exactly what the government wants you to do, to grow the economy through the free market and create more jobs. But of course, there's a catch. You can't just buy any property and call it a day. First, I must make this abundantly clear, just because I know some people are going to watch this and not know this does not apply to raw land. Raw land cannot be depreciated. There must be a structure on there. Second, you must have either, sometimes both, be qualified as a real estate professional or have material participation. Very, very important here. If you're working a normal W-2 job that's not in the real estate industry, you probably won't qualify as a real estate professional. You probably shouldn't even try, but it may be worth checking with your CPA or tax account. But if you have material participation, meaning that you are actively managing, cleaning, marketing, or operating your non-passive property for at least 100 hours a year, you can qualify for these deductions and wipe out a huge portion of your federal income tax. 100 hours a year is approximately 2 hours a week. Very, very doable, even for full-time workers. Now, the non-passive part is extremely important. Now, there are some hoops to jump through, but practically all of our clients can get there. Here's where it gets super powerful though. This massive bonus depreciation deduction, it doesn't just apply to real estate income. Done correctly, and you meeting the qualifications, it can offset your entire W-2 income as well. Okay, so this strategy works when your rental is treated as a non-passive activity. STRs, short-term rentals or vacation rentals, often qualify more easily, but in some cases, long-term rentals can do it as well. It's just more of the exception rather than rule of thumb. And it really depends on the participation and, of course, your real estate professional status. Now, I would highly recommend that you be working with a skilled accountant and tax strategist when it comes to doing anything like cost segs or bonus depreciation. Their fee is well worth it since you'll most likely get a massive refund check in the tens of thousands, in some cases, hundreds of thousands of dollars. Okay, so here's what you need to do. You need to identify and buy a property. Now, this is easier said than done, and if you want to work with me and my team, we can guarantee that we can find you a vetted high-income property. Otherwise, we'll work for you for free. Link down below if you're interested in learning more about how that works. But you do need a property that meets the criteria and that can produce you equity and cash flow. You then need to have it rent ready and income producing by no later than December 31st. You also must have an average stay be less than 7 days. You then need to order a cost segregation report. And this is basically a report that will break down the property so that your accountant can file your taxes. And really a cost segregation study, ideally by qualified engineers, is strongly recommended to allocate components correctly. But if you have detailed records and you can allocate properly because it's a newer construction or fresh remodel or rehab, you may not need an external report, but it's always safer to use one for the audit defense. Now, this is super important. The level of detail in your report depends on the cost of your property. I have a link down below for our cost seg report generator, where you can actually speak to our cost seg accountant and they can take you through the whole process and be done with it in 30 minutes. Now, the next thing you must do is document and track your 100 hours, or at least 100 hours, of anything related to managing and running the real estate business, such as cleaning, managing the crews, bookkeeping, picking up supplies, marketing, you name it, anything that's related. Now, ideally, this is done after you've created your LLC or you've closed on the property. So make sure you track your hours closely. Okay, so now that we know what this is, let's see what this can actually do for you in your taxes if you were to take advantage of this year. Now, let's say that your household brings in a total of $120,000 a year in gross income from you and your spouse's paycheck. We're going to assume just a standard deduction and nothing else special, no dependents or other income streams, just to kind of keep things clean for this example. At the end of the year, you'll be sending the IRS approximately $10,000. Now, $10,000 today is a lot of money in today's economy to watch disappear into a black hole. Personally, I would like to buy an appreciating cash flowing asset with that $10,000 instead of just shipping it off to the government. So let's say that we buy a $350,000 home to short-term rent out. After doing a cost seg report, we're able to depreciate approximately $88,000 from that home. With a good tax strategist and accountant, you'll be able to get your $10,000 back and even reduce your federal income taxes in future years if your tax strategist knows what he or she is doing. And if you want to work with my tax accounting team, I've got a link down below for you too. Okay, remember that borrow till you die tax strategy? That's the philosophy the wealthy live by. They build equity from their investments and their businesses. They borrow against it, live tax-free, and pass it down when they leave this earth. And this is the brilliant thing behind all of it. The deferred taxes, or what we're calling bonus depreciation today, disappears with you. But this bonus depreciation is how you get started today. This is how you generate those massive paper losses that makes your income disappear on paper. So you can not only get started in the game, but stay long enough to scale, refinance, and of course, compound over the years and the decades. And that's the full tax freedom loop. It's the same exact playbook billionaires, developers, and fund managers have used for decades. And they're the same rules every American paying taxes can take advantage of. It's just that a lot of us don't know of it or know how to use it. Now, before you run out and buy the first property you find, I gotta give you a little bit of a warning. I get messages every week from people who did exactly that, and they got the tax break. However, now they're stuck with a property that bleeds cash. It can't sell and it doesn't perform. And ideally, we don't really sell in less than a year. That's really bad for us for tax purposes. The reason behind that is you can't shortcut strategy, especially if you have little to no experience investing or operating a short-term rental business. At the end of the day, it's still a business. You still have teams, you still have a launch, you still have operations, and especially if you have more than one property, you're running a business. Just understand that. But you also need to find the right property in the right market with the right operations and strategy. If you misalign any of those, you can actually be looking at a problem. You basically traded one problem, taxes, for another one, bad debt. In business, we call this being over-leveraged. You make less than what you owe. Now, avoiding taxes is only one piece of becoming wealthy. It's also about understanding and using a system to build the right strategy to take advantage of the rules and the laws in place. And if you want to learn how to do that correctly, my team and I can help you find a vetted high-income property and show you exactly how to apply, implement, and execute this strategy so you can optimize your tax return and have a high cash flowing rental. Just like some of our members and clients here on the screen that we've personally worked with. We believe in so much of what we do, we guarantee our results or we work for you for free. That's it for me today. Stick around and sub to the channel if you want more money and crafty real estate tips and, of course, fun tours. See you next time.